So we've now learned that a company has two ways of raising capital to fund their business: equity or stock, and debt or bonds. By issuing stock, a firm is selling ownership of their company. Because of this, the stockholders are entitled to a slice of the firm's future profits. But if the firm loses all of its value, the stockholders aren't owed anything. They took the risk in exchange for the upside potential. This is why investors' required return on equity is relatively high, because of the risk. Debt, on the other hand, is more like a loan with a specified rate of interest. Because the interest is fixed, the investors don't have any potential for higher gains. But as bondholders, they are protected, typically insured, against the firm's possible bankruptcy. Because of this downside protection, investors' required return on debt is relatively low. A firm's cost of capital represents the rate of return that it must earn on its invested capital in order to pay back all of its investors their respective required rates of return. To find the cost of capital, we must break it down into its various components. As the firm's investors determine its cost of capital, and as they are interested in after-tax cash flows, we must look at the after-tax costs of each type of capital the firm uses. Let's start with debt. The interest expense that a firm pays its bondholders is tax deductible. This means that it can subtract the tax expense from its net income before calculating how much tax it owes. Thus, debt financing effectively creates a tax shield for the company. Basically, the government subsidizes the interest expense on debt. This is one main reason why the cost of debt for a firm is typically lower than the cost of equity. The easiest way to find the after-tax cost of debt is to multiply the investor's required rate of return on debt by 1 minus the tax rate. For example, suppose the yield to maturity on current company bonds is 8%. If the firm's tax rate is 40%, its after-tax cost of debt is, and here we see the equation, the after-tax cost of debt, again, is 1 minus the tax rate times the investor's required rate of return on debt. And we just are given the required rate of return on debt is the yield to maturity on these bonds is 8%. The tax rate is 40%, so we plug that in, and when we calculate this, we see the after-tax rate of return on debt is 4.8%. The second source of capital we're going to look at is preferred stock. This is classically a hybrid security that has fixed coupons as its cash flows, like bonds do, but pays them out indefinitely, like the dividends of a stock. If we know the dividend payments of the preferred stock and how much investors are willing to pay for each share, we can easily calculate the cost of preferred stock, denoted R sub P, for the rate of return on preferred stock. For example, suppose a company can currently issue preferred stock for $90 a share, and each share pays a dividend of $8. Then, the firm's cost of preferred stock is just the dividend divided by the price. It's the percent of the price that is being paid out as a dividend. So it's the $8 dividend divided by the $90 price, or 8.89%. Finally, a firm can use equity to raise capital for new investments. To determine the cost of equity, we have to distinguish between when the firm uses retained earnings versus when it issues new external equity. If the firm uses its retained earnings as new capital, its cost of equity represents a fair rate of return that its shareholders would have otherwise earned if it had paid out dividends. So the retained earnings of a firm are what's left over after it pays out its debt suppliers and its costs of capital and its business expenses. So these retained earnings can either be distributed in the form of dividends or they can be retained and used to grow the company. And that's what we're talking about here. A firm has its retained earnings and it's choosing to use that as a source of capital for new investments, for new projects. And the cost of those, one might think that they're free. It might seem like they can just use those for whatever they want. But because of the opportunity cost to the shareholders of not paying them out in the form of dividends, there is a cost associated with them. So we have to think of the cost of retained earnings as what the shareholders would have earned had we chosen to pay those retained earnings out in the form of dividends. So as we've already learned, there are a couple of ways that we can find investors' required rate of return on equity. So we're going to go through just briefly. We're not going to look at any examples because we've already seen all these. One way we can do it is to use the CAPM, the capital asset pricing model. And this equation just tells us that the required return on equity is a function of the beta risk of the individual firm. So here's this CAPM equation that we've seen before. The required rate of return on this piece of stock for this company is equal to the risk-free rate plus the required rate of return on the market, R sub M, minus the risk-free rate, R sub RF. And again, within that bracket, sometimes we just represent that as a single term, the market risk premium, multiplied by the beta security of this stock. And remember, the beta of a stock or of a firm is just a multiplier, which represents how many times risky is that firm relative to the overall market. So this is one way we can get the required rate of return on our stock, on our equity. The second way is the bond yield plus risk premium method. Using this approach, the required return on equity equals the required return on debt plus a risk premium. And so here we just see the simple equation. The return that we're going to solve for on our stock is equal to the return that our debt holders require plus just some extra risk premium, which would be defined or given to us. And this risk premium represents the difference in risk between being a debt holder and being a stockholder. But this assumes that the difference in risk between bonds and stocks is constant across time. And this may not be a reasonable assumption. So the final way that we can look at the cost of retained earnings is to use the discounted cash flows, or the DCF method. This essentially rearranges the equation that we've already seen for finding the price of a stock. Solved for R sub S, the discount rate, the equation becomes R sub S, the required return on the stock, is equal to the dividend in period 1 divided by the price in period 0 plus the growth rate. So we're used to seeing this equation solve for P sub 0, the price of the stock, in period 0, the current price. So we just rearrange it and solve for the discount rate, and this is just a third way that we can use to get this required return on stock. So in addition to using the retained earnings, a firm can issue new external equity. The difference here is that there are transaction costs of this new equity. So instead of just dipping into the pool of retained earnings, they can actually go out and issue new stock and sell this stock on an exchange to raise money. Typically, a firm will have to float new issues of equity to an exchange through some intermediary, an investment bank or a broker. The intermediary's services are an extra cost to the firm, and these are called flotation costs. As a result, the cost of external equity will be higher than the cost of using retained earnings. Usually, flotation costs, which we usually denote F, are represented as a percentage of the current price of the stock. Then we can use the discounted cash flows method to find the required rate of return on external equity. So this is the equation, and here notice we use the subscript E to denote external equity, as opposed to usually we use the subscript S to denote just common shares that are already part of our retained earnings. So the required rate of return on new external equity, it's the same formula as before, the discounted cash flows formula, except in the denominator we multiply the price of the stock times 1 minus F, the flotation costs. And this takes into account that there's a difference between the price the investors pay for the stock and what we actually receive, because a margin of that, F%, goes to this intermediary, this investment bank or this broker, in order to issue these new shares of stock. Flotation costs can also show up when a firm issues preferred stock. So if we had to find the required rate of return on preferred stock, which we've already talked about, but there was flotation costs associated with issuing new shares of preferred stock, we would do the same thing. We would just add the 1 minus F in the denominator of the equation, the discounted cash flows, to find the required rate of return on preferred stock. And that's the end of part 1.